Good afternoon and welcome. Thank you for joining this briefing on the 2026-27 federal budget, handed down on the 12th of May. The budget contains the most material rewrite of personal investment taxation that we have seen in a generation. 3 measures will reshape how our clients hold and accumulate wealth: a restriction of negative gearing to new residential builds, a 30% minimum tax on the taxable income of discretionary trusts, and the replacement of the long-standing 50% capital gains tax discount with an indexation method and a 30% minimum on net gains. Over the next 20 minutes, we will walk through each measure, illustrate the cash impact with worked examples, and set out a practical action plan. The reforms are still pre-legislative, but the strategic direction is clear and the planning windows are firm. Let us begin. Here is the structure of our briefing today. We will begin with the budget in context, what these 3 reforms mean taken together, and why we are treating them as a single planning project rather than 3 separate issues. We will then examine each reform in turn. First, the restriction of negative gearing on residential property, which takes effect from the 1st of July 2027. Second, the 30% minimum tax on discretionary trust income, which commences a year later on the 1st of July 2028. Third, the replacement of the 50% capital gains tax discount with an inflation indexation model and a 30% minimum tax floor, which takes effect from the 1st of July 2027. Finally, we will set out a practical action plan and the decisions that should be made in the planning window between now and 30 June 2030. There will be time for questions at the end. Let me give you the strategic frame for the briefing. These 3 reforms are best understood as a single coordinated policy package. They diminish, in different ways, the after-tax appeal of 3 of the most familiar wealth-building structures used by Australian private clients: leveraged residential investment property, the discretionary family trust, and the long-hold capital growth asset. That coordination matters. The government is forecasting more than $3.5 billion of savings over 4 years from these investment tax reforms alone, contributing to a $45 billion reduction in the projected budget deficit. Tax receipts will move from 23.6% to 23.8% of GDP. Tactically, this creates a structured planning runway. The window between budget night of the 12th of May 2026 and the 1st of July 2027 is the principal opportunity to optimise positions under the existing rules. The 3-year rollover relief window from July 1st, 2027 to June 30th, 2030 is the runway for restructuring family trusts under expanded concessions. Clients with existing investment properties, discretionary trust structures, or substantial unrealised capital gains should treat the next 12 to 24 months as a decision-making period, not a wait-and-see period. Let us start with negative gearing. From the 1st of July 2027, losses arising on established residential investment properties will only be deductible against rental income from residential property or against capital gains on residential property. Offset against unrelated income, salary, business income, share dividends will no longer be available. Excess losses will be carried forward and ring-fenced to the same class of income. The grandfathering rules are the most important part of this slide. 3 timelines matter. First, properties owned at 7:30 p.m. Australian Eastern Standard Time on budget night, including those under contract but not yet settled, are grandfathered until disposal. They continue under the present rules. Second, established residential property acquired between budget night and the 1st of July 2027 may be acquired but does not receive grandfathering, and from 1st July 2027 will fall under the loss quarantining rule. Third, eligible new builds remain outside the restrictions altogether, regardless of acquisition date. There are 3 categories of exclusion: grandfathered properties, eligible new builds, designed to direct the concession to investment that adds to housing stock, and widely held trusts and superannuation funds, including targeted exemptions for build-to-rent and private investors supporting government housing programs. The measure is targeted only at residential premises. Negative gearing on shares, commercial property, and other asset classes is unaffected. Let us bring the negative gearing reform to life with a worked example. Consider a high net worth client on a 47% marginal rate who acquires an established residential property in August 2027 for $1.5 million. She uses an 80% interest-only loan at 6.5%. The annual cash flow is the same in all three scenarios: $48,000 of rent, $78,000 of interest, $12,000 of other deductible costs, producing a net rental loss of $42,000. Under the pre-reform rules, that $42,000 loss offsets her salary income and generates a tax saving of $19,740 in year one. This is the familiar negative gearing arithmetic. Under the post-reform rules, for an established property acquired after budget night, the same $42,000 loss is quarantined. It is carried forward and usable only against future rental income from residential property, or against capital gains on residential property when she eventually sells. Her year one tax saving is nil. The economic value is deferred, often by many years, and discounted at her cost of capital. If instead she acquires an eligible new build, an off-the-plan apartment or a house and land package, she retains the full pre-reform tax shield. The new build pathway is the most tax-favoured category of residential investment under the new regime. The takeaway figure for the slide is that bottom strip. $19,740 of year one tax shield is forfeited on each non-grandfathered established acquisition. Now to the second of the three reforms, the 30% minimum tax on discretionary trust income, which commences on the 1st of July 2028. The mechanism is critical. From that date, the trustee of a discretionary trust will pay a minimum tax of 30% on the taxable income of the trust. Beneficiaries, other than corporate beneficiaries, will receive non-refundable credits for the tax paid by the trustee. The budget papers expressly describe this as a minimum floor. It operates in substance more like a withholding regime than the present Section 98 and 98A mechanism, where a beneficiary on a lower marginal rate can claim a refund of trustee tax. That is the change. Today, distributing income to a low marginal rate beneficiary attracts low or zero tax. From 1st July 2028, the trustee has already paid 30%, and that 30% is not refundable. The scope captures the conventional family trust, discretionary trusts used for trading businesses, investments, and family wealth pools. It does not capture fixed and widely held trusts, complying superannuation funds and SMSFs, special disability trusts, deceased estates, or charitable trusts. There are also 4 important income carve-outs that escape the floor even within a discretionary trust: primary production income, income relating to vulnerable minors, income subject to non-resident withholding, and crucially, income from the assets of existing discretionary testamentary trusts. That last carve-out makes testamentary trusts comparatively attractive for estate planning purposes. And to soften the transition, the government will provide expanded rollover relief for 3 years from July 1st, 2027. Supporting restructures out of discretionary trusts into companies or fixed trusts. This slide illustrates who actually bears the economic cost of the trust 30% floor. Assume a family trust with $200,000 of taxable income distributed across 3 adult beneficiaries. Beneficiary A has no other income and receives a $100,000 distribution. Under the current rules, A pays tax of $20,788 on the distribution. Under the post-2028 rules, the trustee has paid $30,000 at the floor rate, and A cannot reclaim the difference. A's total tax has risen by $9,212. Beneficiary B has $50,000 of salary income and receives a $50,000 distribution. Under the current rules, B's marginal tax on the distribution is $15,000. Under the new rules, the trustee pays $15,000, which exactly matches B's marginal rate liability. No additional tax, but the cash has left the trust earlier. Beneficiary C has $200,000 of other income and receives a $50,000 distribution. His marginal rate liability is $22,500. The trustee pays $15,000 at the floor, and C tops up the remaining $7,500. Again, no change in total tax, but timing has been brought forward. The pattern is unmistakable. Beneficiaries on marginal rates below 30% bear the full cost of the reform. beneficiaries already on or above 30% face cash flow timing only. The traditional logic of family trusts, splitting income to lower rate beneficiaries, such as adult children at university, is no longer economically rewarded. Our third reform is the replacement of the 50% capital gains tax discount. For disposals on or after the 1st of July 2027, the existing 50% discount for individuals, trusts and partnerships is replaced by an inflation indexation method and a minimum 30% effective tax rate on the resulting net capital gain. The change is prospective. Gains accrued before July 1st, 2027 retain access to the 50% discount, and gains accrued from 1st July 2027 onwards are taxed under the new method. There is no facility to revalue assets at 1st July 2027. The transitional split is by time apportionment. 3 additional points are critical. First, pre-1985 assets are now in scope. Family farmland, heritage shareholdings and founder equity acquired before the 20th of September 1985 becomes subject to CGT for disposals from 1st July 2027, although gains accrued before that date remain CGT free. Second, eligible new residential builds carry an election to retain the 50% discount in lieu of the new method, a meaningful concession when combined with retained negative gearing. Third, income support recipients, including age pensioners, are exempt from the 30% floor. The worked example on the right tells the story. An asset acquired for $500,000 and sold for $1.2 million by an investor on the 45% marginal rate. Under the discount method, the taxable gain is $350,000 and the tax is $157,500. Under the indexation method, the index cost base rises to $726,900. The taxable gain is $473,100 and the tax climbs to $212,900. An additional $55,408 of tax, an increase of roughly 35% on that single disposal. The pattern, where real returns are strong relative to inflation, the new method captures more of the gain. Where inflation is elevated, the gap narrows but rarely closes. Before we move to the action plan, it is worth pausing on how the 3 reforms interact. Each stands alone, but the value of planning multiplies when they are considered together. First, the interaction between quarantined rental losses and the new CGT regime. From 1st July 2027, ring-fenced rental losses from established residential properties remain usable against capital gains on residential property. So, long-hold investors retain some tax shield. But the gain itself is now taxed under the indexation method with a 30% floor. So the timing of the offset is back-ended and the underlying gain is more heavily taxed. The economic value is materially less than the immediate annual deduction it replaces. Second, capital gains realised inside a discretionary trust after the 1st of July 2028 are exposed to the trustee floor. The familiar strategy of streaming capital gains down to a low MTR beneficiary loses most of its value. For capital growth assets, the discretionary trust becomes a relatively poor holding vehicle compared to personal direct ownership by a low MTR family member, or better, holding within superannuation. Third, the superannuation environment becomes comparatively more attractive. Treasury confirmed during the budget lockup that complying super funds, including SMSFs, will continue to apply the existing 1/3 CGT discount under Section 115-100, producing an effective 10% tax rate on long-held gains within the fund. None of the 3 reforms changes that. So within concessional contribution caps and the existing total superannuation balance rules, superannuation is a meaningfully better home for long-hold growth assets after the reforms than it was before. Here is the action plan, organised by planning window. Between now and the 30th of June 2026, the priority is information capture, a property and trust inventory across the family group, and documentation of grandfathering, particularly evidence of contracts signed before budget night that may not yet have settled. Between now and the 30th of June 2027, we move into modelling and decision, identifying unrealised gains by asset and structure, deciding which to crystallise before the 50% discount window closes, and developing the trust restructure strategy, which trusts to retain on non-tax grounds, which to roll into a company or fixed trust under the upcoming rollover relief. Between 1st July 2027 and 30th June 2030, the 3-year rollover window, we execute the trust restructures, and we reweight any new property acquisition policy toward eligible new builds and build-to-rent product. Pre the 1st of July 2028, we refresh testamentary trust deeds to preserve the carve-out for assets held at announcement, and we update estate plans accordingly. And on an ongoing basis, we run cash flow stress testing on leveraged property positions, assuming the loss of the negative gearing tax shield on non-grandfathered acquisitions, and we monitor the consultation and draft legislation process for refinements. Each of these reforms will pass through consultation, draft legislation, and parliamentary scrutiny before becoming law. 6 issues are particularly material, and we will issue further client notes as the detail emerges. First, the definition of new residential premises for the purposes of both negative gearing and the CGT new build election. The GST Act already contains a definition, but whether the government will adopt it, wholesale, modify it, or write a bespoke version is open. The treatment of secondary purchases of new builds is a particular focus. Second, whether quarantined rental losses are pooled across an investor's residential portfolio or are tied to the specific property that generated them. The more restrictive interpretation, per property, is what we recommend you assume until clarified. Third, the mechanics of the CGT transitional rule, whether gains will be split between pre- and post-July 1st, 2027 by time apportionment, formula, or asset-by-asset election. Fourth, the definition of vulnerable minors for the Trust 30% carve-out, narrower than Division 6AA, but otherwise undefined. Fifth, the eligibility criteria for the expanded rollover relief, whether the existing small business aggregated turnover thresholds will apply, or whether it will be broadly available. And sixth, the franking account interaction where the trustee 30% is paid and the trust subsequently distributes to a corporate beneficiary. The mechanics of credit attribution matter for the practical use of bucket company structures. These are the areas we are watching most closely, and we expect significant refinement during the consultation period. Before we close, let me consolidate the case for acting now rather than waiting for legislation. There are 3 reasons. First, the grandfathering moment for negative gearing has already passed. Properties held, or under contract at 7:30 p.m. on the 12th of May 2026 are grandfathered, and that classification follows the property until disposal. But the position must be documented now, while contracts, settlement statements, and ownership records are easily reconstructed. Anything that disturbs grandfathering, for example, transferring an established property from joint personal names into a discretionary trust, should not happen unless there is a compelling non-tax reason. The grandfathered status is the most valuable element of the entire reform package, and it is fragile. Second, the 50% CGT discount will be frozen at 30 June 2027. That is 14 months from today. Selective realisations of long-held gains before that date can lock in the discount on the accrued portion. After 1st July 2027, post-2027 accrual is taxed under indexation and a 30% floor. Identifying candidate disposals and modelling them against your reinvestment opportunity set is a defined and time-limited piece of work. Third, the expanded trust rollover relief is open from 1st July 2027 to 30th June 2030. That is 3 years to restructure out of discretionary trusts into companies or fixed trusts without incurring CGT cost on the rollover. Outside that window, restructure economics deteriorate sharply, CGT, and, depending on the state, stamp duty re-emerge in full. The combined message: this is a planning project, not a wait-and-see project. So to close, 3 things we recommend you do this month. First, schedule the strategy review. We are setting aside 90-minute working sessions with each client family this quarter to map your structures against the 3 reforms, identify the candidate decisions, and frame the planning runway. The earlier in the window we have that conversation, the more options we preserve. Second, gather the information pack. The 4 documents we need from you are a property schedule across the family group with acquisition and settlement dates, a trust register covering deed dates, trustees, beneficiaries, and recent distribution history, an unrealised gains schedule for major investment assets, and the most recent income tax returns for the individuals, trusts and companies in scope. Third, we will calibrate the accompanying Excel impact model to your actual numbers and produce a tailored client memorandum picking up the specific decisions for your structures. The model lets us run sensitivities, change marginal rates, change the rollover timing, change the new build versus established mix, and see the after-tax consequences in real time. I have left our contact person's details at the bottom of the screen. Please do not hesitate to contact me directly or reach out through your usual relationship contact at Quantum House. We are looking forward to working with you through what is, without question, the most consequential reform window for private client tax planning in over 2 decades. Thank you for your time.